Wealth Blueprint. Master the Principles of Financial Freedom. Written and published by Mindset Masters Audiobooks. Part 1. Building the Foundation of Financial Freedom. Every great achievement begins with a blueprint. Just as an architect would never start constructing a skyscraper without a detailed plan, no one can achieve financial freedom without a structured foundation. Wealth is not the result of chance, luck, or circumstance. It is the product of clear principles applied consistently over time. The first step in building this foundation is to redefine what financial freedom truly means. For some, it is the ability to retire early. For others, it is having the resources to travel, take care of family, or pursue passions without worrying about money. Regardless of the definition, financial freedom always comes down to one thing: the ability to live on your terms because money works for you, not against you. The truth about financial freedom. Financial freedom isn't about millions sitting in a bank account. It's about creating systems where your income is not tied directly to the hours you work. A person with modest, passive income that covers all their living expenses is more financially free than a high-paid executive who relies solely on a paycheck and debt to maintain their lifestyle. The foundation of wealth is built on 3 pillars: mindset, developing the beliefs and habits that attract and sustain wealth; management, learning how to handle money with discipline and clarity; multiplication, using your resources to generate more income through investing, skills, and opportunities. Without the first two, multiplication becomes dangerous. People who attempt to grow wealth without first having the right mindset and management often end up in cycles of debt, failed investments, or financial instability. Defining your why. Before embarking on the journey to financial freedom, you must define your why. Why do you want to be financially free? Is it for your family? To escape a stressful job? To create generational wealth? Your why becomes your anchor. It keeps you disciplined when distractions, temptations, or setbacks arise. Write it down, make it specific, and return to it often. A clear why will guide every financial decision you make. The wealth equation. At its core, wealth is built on a simple equation: income, expenses, margin, raw margin invested, wealth growth. Raw margin income is the money you earn. Expenses are what you spend. Margin is the gap between the two. When margin is invested wisely instead of consumed, wealth grows. Most people fail at the margin step. They increase income but allow expenses to rise equally, leaving nothing to invest. The wealthy focus relentlessly on protecting and growing their margin, laying the groundwork. Key habits for financial freedom. To prepare the soil for long-term wealth, begin with these habits. Track every dollar. Awareness is the first step to control. If you don't know where your money goes, you can't direct it toward your goals. Cut unnecessary expenses. Every dollar wasted is a seed that could have been planted. Evaluate subscriptions, impulsive purchases, and lifestyle inflation. Save before you spend. Automate savings and investments the moment income arrives, treating them like non-negotiable expenses. Eliminate debt aggressively. Debt drains your margin and your peace of mind. Pay down high-interest debt as quickly as possible. Invest in yourself first. Skills, knowledge, and discipline are the foundation of income growth. The long-term vision. True financial freedom requires patience. There is no shortcut or magic formula, but those who commit to the long-term vision, protecting their margin, investing consistently, and growing their mindset, inevitably achieve it. Wealth is not a sprint, it's a marathon of disciplined, intentional action. Part 2. The wealth mindset shift. Wealth does not begin in the bank account. It begins in the mind. If your mindset is limited, fearful, or rooted in scarcity, no amount of money will ever feel enough. This is why lottery winners often lose everything, while disciplined entrepreneurs with far fewer resources build fortunes over time. The wealth mindset requires reprogramming how you think about money, opportunity, and discipline. Scarcity versus abundance. Thinking, scarcity says, there's never enough. I must hold tightly to what I have. Abundance says, there's more than enough. I can create, multiply, and expand. Scarcity leads to fear-based decisions, missed opportunities, and self-sabotage. Abundance leads to creative problem-solving, investments, and growth. Shifting from scarcity to abundance is not about reckless spending. It's about believing that wealth can be built through consistent, intelligent actions. Breaking limiting beliefs about money. Most people carry subconscious money beliefs passed down from family, culture, or personal experience. Common limiting beliefs include: run to qual, money is evil; Rich people are greedy. I'm not smart enough to invest. I'll never earn more than what I do now. Each of these beliefs acts as an invisible ceiling. To rise above them, you must confront and replace them with empowering truths. Money is neutral. It amplifies who you are. Wealth allows generosity and impact. Anyone can learn the principles of investing. Your earning potential grows with your skills, creativity, and persistence. Delayed gratification, the core of wealth. One of the most powerful traits of the wealthy is the ability to delay gratification. They are willing to sacrifice comfort today for freedom tomorrow. This means driving a modest car instead of financing luxury, investing instead of spending bonuses, and choosing assets over liabilities. Every purchase should be filtered through this mindset. Does this bring me closer to financial freedom, or does it take me further away? Rewiring daily thinking. Wealth is the result of small, repeated decisions compounded over years. Train your mind daily with these practices. Visualization. Imagine your life of financial freedom clearly, where you live, how you spend your time, the impact you make. Affirmations. Replace limiting beliefs with empowering statements like, I am disciplined with money. I create wealth through wise choices. Environment. Surround yourself with people, books, and content that expand your vision, not shrink it. Shifting from consumer to investor. Most people live as consumers, constantly buying, upgrading, and spending. The wealthy live as investors, looking for ways to grow money, acquire assets, and build cash flow. Every dollar has two choices, to be consumed or to be invested. When you shift your identity from consumer to investor, your financial reality transforms. The role of responsibility. Finally, wealth mindset is rooted in radical responsibility. Instead of blaming the economy, upbringing, or circumstances, the wealthy say, my financial future is in my hands. This responsibility is empowering because it means you always have the power to change your financial direction. Part 3. The power of financial discipline. Wealth is not built on a single breakthrough, but on disciplined actions repeated consistently over time. Discipline is the invisible bridge between financial knowledge and financial freedom. Without it, even the best strategies collapse. With it, even modest incomes can grow into lasting wealth. The habit of tracking money. What gets measured gets managed. The wealthy know exactly where their money goes. Every expense, every investment, and every dollar earned is accounted for. Tracking money doesn't mean obsessing over every coin, it means developing clarity. When you track, you see patterns, unnecessary subscriptions, impulse purchases, or money leaks that could otherwise be redirected into assets. Tools like budgeting apps, spreadsheets, or even a simple notebook help reinforce this discipline. The goal is awareness, because awareness creates control. The budget as a wealth tool. Many resist the word budget, thinking it means restriction. In reality, a budget is freedom. It's a plan for your money, telling every dollar where to go instead of wondering where it went. Wealthy individuals don't wing it. They create intentional money plans. A strong budget allocates essentials, housing, food, utilities, savings, for emergencies and investments, growth, skills, business or opportunities, enjoyment, lifestyle choices within limits. By living on less than you earn, you create the gap that becomes your wealth-building fuel. Self-control in spending. Impulse is the enemy of wealth. Advertisers and marketers are experts at exploiting emotions to make you spend. Discipline means pausing before purchases and asking, do I need this? Will it increase my long-term freedom? The wealthy often practice the 24-hour rule, delaying non-essential purchases for a day. This short pause reduces emotional buying and reinforces long-term thinking. The discipline of saving first. Most people spend first and save what's left. The wealthy reverse this. Save first, spend what remains. This single discipline shifts the entire trajectory of financial life. Automatic transfers to savings or investment accounts ensure consistency without relying on willpower. Think of saving as paying your future self before paying anyone else. Building systems, not willpower. Discipline becomes easier when it is built into systems. Instead of relying on motivation, the wealthy design environments that make discipline natural. Automatic bill payments to avoid late fees. Automatic investments so money grows without constant decision-making. Separate accounts for spending, saving, and investing to reduce confusion. Systems transform discipline from effort into habit. Consistency over perfection. Financial discipline does not mean never making mistakes. It means staying consistent even after setbacks. Everyone faces unexpected expenses, market downturns, or bad decisions. The key is returning to your disciplined habits immediately rather than abandoning them. The wealthy understand that discipline compounds. Small acts, saving a percentage, resisting impulse, reinvesting profits, stack up into massive outcomes over time. Sacrifice today, freedom tomorrow. At its core, financial discipline is about trade-offs. Choosing to live below your means today is not about deprivation, it's about buying freedom. Every dollar you save and invest is a soldier working for you. Every dollar spent on fleeting pleasure is gone forever. Discipline ensures that your money works harder for you than you work for money. Part 4. Mastering the art of earning more. While saving and discipline lay the foundation, wealth cannot be built on cost-cutting alone. There is a limit to how much you can reduce expenses, but there is virtually no limit to how much you can increase income. The wealthy understand this principle deeply. They do not settle for a single stream of earnings. They diversify, expand, and constantly seek ways to grow their financial inflow. Breaking free from the single income trap. Relying solely on one paycheck is financial vulnerability. If that income stops, so does your stability. The wealthy counter this by building multiple streams of income. Primary income, often from a career or business. Secondary income, side hustles, consulting or freelancing. Passive income, investments, royalties, rental properties or dividends. This diversification acts like financial insurance. If one stream slows down, others keep flowing. The mindset shift, from employee to value creator. Most people think in terms of hours worked. Wealthy individuals think in terms of value created. They ask, how can I solve problems for more people? How can I package my knowledge, skills or resources in a way that scales? Instead of trading time for money, they leverage time, knowledge and capital. For example, an employee tutors students after work, trading time for extra cash. A wealthy thinker creates an online course that students can access forever, earning while sleeping. The shift is from effort-based earnings to system-based earnings, developing high-income skills. The quickest way to increase income is to master skills that command higher pay. Some examples include sales and persuasion, digital marketing, copywriting and content creation, software development and technology expertise, public speaking, coaching or consulting. These skills are in constant demand and often allow you to set your own rates. The wealthy consistently invest in learning because each new skill increases their earning potential exponentially. The power of leverage. Wealth builders use leverage, systems, tools, and people that multiply results. Examples include technology leverage, building apps, websites, or using automation. Financial leverage, using other people's money, investors, bank loans, to fund profitable ventures. People leverage, hiring or partnering with others to expand capacity. The average person tries to do everything alone. The wealthy use leverage to extend beyond their own time and effort. Turning passions into profits. Another key principle, the wealthy often monetize what they enjoy. Passion fuels persistence, and persistence fuels success. Whether it's writing, design, fitness, teaching, or investing, almost every passion has a market if packaged correctly. The challenge is thinking creatively. How can I serve others with this passion in a way they will pay for? Building assets, not just income. Earning more is not just about making cash, it's about channeling that income into assets that produce future income. A high-paying job alone doesn't make someone wealthy, but when those extra earnings are invested into stocks, real estate, businesses, or intellectual property, they create wealth that compounds. The wealthy don't only chase a bigger paycheck, they transform their earnings into long-term streams that outlast them. The role of networking and collaboration. Earnings are often tied to opportunities, and opportunities come through people. Wealthy individuals actively build networks, collaborate, and position themselves where money flows. They understand that one good connection can unlock a deal, a partnership, or a chance that multiplies income beyond what solo effort could achieve. Networking is not exploitation, it's value exchange. You build wealth by helping others win while creating pathways for your own success. Part 5. The discipline of managing money wisely. Earning more is powerful, but without management, money slips through your fingers. Many high-income earners stay broke because they lack financial discipline. Wealth is not only about how much you make, but how effectively you manage what you keep. The wealth formula: income, expenses, capital for growth. The wealthy view money as a resource to be directed with purpose. They apply a simple formula: earn aggressively through multiple streams, spend intentionally with clarity on priorities, invest the difference into assets that grow. For the average person, Income comes in, expenses consume it, and little remains. For the wealthy, income flows in, they filter it through priorities, and what's left is fuel for building more wealth. Budgeting as a wealth tool. Budgeting is not about restriction, it is about control. The wealthy use budgets to direct money where it creates the most value. A good budget doesn't mean denying yourself, it means knowing exactly where each dollar goes. They often apply systems like the 50-30-20 rule, 50% necessities, 30% wants, 20% savings investments. Discipline in budgeting transforms money from something you chase into something you command. Avoiding lifestyle inflation. One of the biggest traps that keeps people poor, even when their income grows, is lifestyle inflation. When they earn more, they spend more. A bigger car, a larger house, fancier clothes. Instead of building assets, they build liabilities. The wealthy resist this temptation. They understand that just because they can afford something doesn't mean it adds value. They allow their wealth to grow first, before increasing lifestyle comforts. A practical rule: upgrade your lifestyle only when your assets, not your labor, pay for it. Tracking cash flow. The wealthy constantly know their numbers. They track income, expenses, debts and assets with precision. This doesn't require advanced math, just awareness. They use simple tools, annual reviews of financial growth to assess progress. Tracking builds clarity, and clarity drives better financial decisions. Building an emergency fund. A core principle of money management is security. The wealthy always have a financial cushion. They aim for 6-12 months of expenses set aside in liquid, accessible accounts. This fund prevents them from panic selling investments or falling into debt when unexpected events occur. Stability allows them to stay patient with long-term wealth strategies instead of reacting emotionally to crises. The smart use of debt. Debt can destroy wealth, but it can also build it if used strategically. The wealthy distinguish between bad debt, credit card balances, high-interest loans and borrowing for consumption. Good debt, mortgages on appreciating assets, business loans that generate more income, or financing that multiplies returns. They avoid bad debt at all costs and use good debt carefully, ensuring it produces cash flow greater than its cost. Practicing delayed gratification. Wealth requires patience. Instead of spending for instant pleasure, the wealthy redirect resources into future gains. This does not mean they never enjoy their money, it means they understand timing. For example, Rumkolv, instead of buying the latest gadget on credit, they invest first, then use returns to purchase luxuries. Instead of rushing into a flashy car, they grow investments that later pay for the car effortlessly. Delayed gratification is not denial, it is trading temporary pleasure for permanent freedom. The role of financial boundaries. Wealthy individuals also protect their money from unnecessary leaks caused by social pressure. They set boundaries with family, friends and lifestyle expectations. Saying no to financial drains allows them to say yes to wealth creation. They understand generosity is powerful but should be intentional, not forced by guilt or appearances. Money as a servant, not a master. At its core, money is a tool. The wealthy never let it control their emotions or decisions. They don't overspend to impress, nor do they hoard out of fear. Instead, they treat money as a servant, directing it to serve their vision, freedom and legacy. Part 6. The power of investing and compounding. Wealth grows not by saving alone but by putting money to work. The wealthy understand that money is a seed. Left idle, it remains a seed. Planted wisely, it multiplies into an orchard. Investing is the discipline of directing money into vehicles that generate more money, and compounding is the force that makes this growth exponential. Understanding the wealth equation. At the core of wealth building lies this equation. Money provides the seed. Time allows compounding to work its magic. Discipline ensures you remain consistent, avoiding rash decisions that destroy progress. Those who respect this formula eventually experience financial breakthroughs. The principle of compounding. Compounding is often called the eighth wonder of the world. It is the process where your money earns returns, and those returns begin earning returns of their own. Over time, the curve of growth shifts from slow and steady to exponential. For example, if you invest $500 per month with an average 10% annual return, after 10 years, you'll have around $95,000. After 20 years, about $345,000. After 30 years, over $1,000. Notice that the largest growth happens later, not at the beginning. The wealthy stay patient long enough to let compounding reward them. The different vehicles of investment. The wealthy diversify their portfolios across different asset classes, Each has its own level of risk, reward, and liquidity. Stocks and equity markets. Investing in companies gives you ownership and the chance to grow as businesses succeed. Stocks are volatile in the short term but powerful in the long term. Wealthy investors prioritize strong companies, dividend-paying stocks, and index funds for steady growth. Real estate. Property provides both cash flow and appreciation. Rental properties generate income while values often rise over time. The wealthy use real estate to hedge against inflation and build generational wealth. Businesses. Starting or investing in businesses provides the highest potential returns but also the highest risk. Wealthy individuals often reinvest earnings into ventures they understand well. Bonds and fixed income. Bonds provide lower returns but more stability. They are used to balance portfolios and create predictable income streams. Alternative assets. The wealthy sometimes invest in commodities, art, or even digital assets. They do so strategically, ensuring these remain a smaller portion of their portfolios compared to proven long-term investments. Risk management in investing. The wealthy are not gamblers. They respect risk and manage it carefully. Their strategies include diversifying investments to spread risk, avoiding emotional decisions during market fluctuations, investing only what they can afford to leave untouched long-term, conducting due diligence before committing money. They know that wealth is not built overnight, but through steady, disciplined exposure to calculated risks. The rule of reinvestment. Instead of spending returns, the wealthy reinvest. They allow earnings to fuel more growth. For example, dividends are not withdrawn but reinvested into more shares. Rental profits are not all consumed but used to acquire more properties. This cycle creates a snowball effect, where money grows faster and faster with time. Patience as a wealth multiplier. Most investors fail because they lack patience. They panic during downturns and chase hype during peaks. The wealthy remain calm. They know that markets move in cycles, and time rewards discipline. They view downturns as opportunities. When markets fall, they acquire assets at discounted prices, knowing recovery will eventually multiply their gains. The investor's mindset. The wealthy approach investing with a long-term lens. Instead of obsessing over daily market changes, they think in decades. Their questions are, will this asset still have value in 20 years? Does this investment align with my overall wealth strategy? Am I investing in something I understand and believe in? This mindset shields them from short-term noise and aligns them with long-term prosperity, avoiding get-rich-quick traps. Wealthy individuals avoid schemes promising fast riches. They know wealth is built systematically, not magically. Scams thrive on impatience. The wealthy refuse shortcuts, recognizing that the only sustainable path is discipline, strategy, and time. Building systems of automatic investing. To protect themselves from inconsistency, many wealthy people automate their investments. They set up recurring contributions into funds or accounts, ensuring that investing happens whether they feel motivated or not. This system removes emotion and guarantees steady wealth growth over years. Part 7. The psychology of money and emotional intelligence in wealth. Wealth is not only built with numbers, it is built with mindset. Many people lose money not because they lack opportunity, but because they lack the right relationship with money. The wealthy understand that psychology and emotional intelligence are just as important as financial literacy. Without mastering the inner game, even the most sophisticated strategies collapse under fear, greed, or poor decisions. The emotional traps around money. Human behavior often works against wealth building. Common emotional traps include fear of losing. Some people avoid investing altogether because they fear risk. This fear keeps them stuck in saving alone, never giving compounding a chance to work. The wealthy manage fear with knowledge and diversification, not avoidance. Greed and overconfidence. Others chase high-risk opportunities because they want to get rich quickly. They believe they can outsmart the market or ride a wave of speculation. This leads to huge losses when reality corrects irrational exuberance. Shame and guilt. People often feel ashamed of past financial mistakes or guilty for wanting wealth. These emotions create paralysis instead of growth. The wealthy accept mistakes as lessons and view money as a neutral tool. Impatience. Most want instant results. When wealth doesn't appear quickly, they abandon their plan. The wealthy understand that patience is a discipline, not a weakness. Money is a tool, not an identity. Those who fail financially often tie their self-worth to money. They believe having less makes them less valuable. The wealthy separate identity from money. They see it as a tool for freedom, security, and impact. Money does not define who they are, it serves what they build. This detachment helps them make rational choices without the emotional burden of ego. Scarcity versus abundance mindset. The wealthy cultivate an abundance mindset. Scarcity says, there's not enough, so I must cling tightly. Abundance says, opportunities are limitless, and with discipline I can create wealth. Scarcity thinkers hoard, fear risk, and sabotage their growth. Abundance thinkers invest, share, and trust the process of value creation. This mindset shift changes everything. It transforms money from something to protect into something to multiply. Emotional intelligence in financial decisions. Emotional intelligence, the ability to understand and manage emotions, protects wealth in moments of uncertainty. The wealthy practice self-awareness, recognizing when emotions like greed or fear are influencing decisions, self-regulation, pausing before reacting, staying calm in financial storms, long-term thinking, choosing delayed gratification over impulsive spending, resilience, recovering quickly after financial setbacks. These skills help them stay steady when others panic, positioning them to seize opportunities others miss, healing money wounds. Many grow up with limiting beliefs about money. Phrases like money is the root of all evil, or rich people are greedy, can sabotage wealth creation. The wealthy challenge and replace these narratives. They embrace beliefs like, money amplifies who you already are. Wealth allows you to serve, not just consume. There is no shame in prospering through discipline and value creation. Healing these wounds removes internal resistance to success. The wealth identity. The wealthy don't just practice habits, they embody an identity. They see themselves as disciplined investors, responsible stewards, and creators of value. This identity guides their actions naturally. Someone who identifies as bad with money will unconsciously sabotage opportunities. Someone who embraces the identity of a disciplined wealth builder will act in alignment with it. The role of gratitude. Gratitude may seem unrelated to finance, but it shapes perspective. When you are grateful for what you have, you make decisions from strength rather than desperation. The wealthy practice gratitude to maintain emotional balance, especially when markets or life feel uncertain. Detachment from outcome. The wealthy focus on process, not outcome. Instead of obsessing about how much their portfolio gained this month, they focus on whether they followed their system consistently. This detachment keeps them grounded. Ironically, by caring less about short-term results, they achieve greater long-term outcomes. The wealth thermostat. Every person has an internal money thermostat, an unconscious comfort level with wealth. If someone's thermostat is set low, they will unconsciously sabotage gains because wealth feels unsafe. The wealthy reset their thermostat higher by normalizing prosperity, surrounding themselves with financially healthy environments, and affirming that wealth is natural when earned with discipline. Building emotional mastery around money. The true advantage of the wealthy lies here: emotional mastery. Anyone can learn how to save or invest. Few can remain calm while others panic, patient while others rush, and disciplined while others get distracted. Emotional intelligence transforms wealth from something external to something internal, no longer dependent solely on markets but on the mindset and choices of the individual. Part 8. Creating multiple streams of income. One of the most powerful wealth principles the rich live by is diversification, not just in investments but in income itself. Relying on a single source of money is fragile. If it dries up, your financial stability collapses. The wealthy build multiple streams of income so that money flows from different directions, reducing risk and compounding growth. Why a single stream is dangerous. Most people depend solely on their paycheck. While stable, it creates vulnerability. A job loss means losing everything at once. Salary growth is limited by employer decisions. One economic shift can wipe out security. The wealthy think differently. They view one stream as the starting point, not the finish line. The wealth framework of income streams. There are 3 broad categories of income. Earned income. This is money you trade time for, your job, freelance work, or consulting. The wealthy often start here, but they don't stop here. Passive income. Income earned without active daily involvement. Investments, rental properties, royalties, or automated businesses. Portfolio income. Growth from investments like stocks, bonds, or mutual funds. This is where money compounds and multiplies. The wealthy focus on building all 3, ensuring they are never trapped in dependency on one source. Building additional streams, step by step. Strengthen your core income first. Your main job or business funds the building of other streams. Before branching out, maximize your skills, negotiate raises, or scale your business. Invest in skills that multiply value. High-income skills, like sales, marketing, software development, or investing, create leverage. Wealthy individuals invest in their growth to create opportunities for new streams. Channel surplus into assets, not liability. Instead of spending extra income on lifestyle upgrades, they direct it into assets that produce future income. Automate growth. Setting up systems like automatic investment contributions ensures consistent progress toward building passive streams. Examples of wealthy income streams. The wealthy diversify in creative ways, often combining real estate, rental properties, commercial spaces, or real estate investment trusts, REITs, dividends and stocks, cash flow from ownership in public companies, businesses, either hands-on or delegated to managers, digital products, courses, audiobooks, or online platforms that sell repeatedly without added effort, royalties from intellectual property such as writing, art, or patents, peer-to-peer lending or private equity, where capital is lent or invested in exchange for returns. They don't pursue all at once. They build gradually, mastering one stream before moving to the next. The power of compounding streams. The wealthy think in decades, not days. They know that one rental property may not change everything, but 10 over 20 years will. One side business may seem small, but combined with investments, dividends, and royalties, it creates unstoppable momentum. Each stream feeds the others. Drov income funds investments. Dividends are reinvested into real estate. Real estate cash flow funds a new business. This cycle expands wealth organically. Active versus passive focus. In the early stages, additional streams are often active, requiring time and energy. Over time, the goal is to shift balance toward passive streams, where money flows without your constant presence. The wealthy are willing to work hard up front for systems that pay them later. Protecting and managing streams. Diversification requires management. The wealthy ensure that income is tracked separately and reinvested wisely. No single stream dominates more than 50% of their wealth. Risks are spread across industries and geographies. This keeps their wealth resilient even during downturns. The mindset behind multiple streams. At its core, multiple streams are not just about security, but about freedom. The wealthy believe, I should never depend on one decision maker for my livelihood. Money should be a river, not a pond. Each stream I build increases my choices and reduces my fears. This mindset fuels their determination to keep expanding. The wealth flywheel. Over time, multiple streams form a flywheel effect. Instead of stressing about a paycheck, money works in the background. Each stream reduces pressure, allowing more creativity and boldness. Opportunities that once felt risky become manageable because they no longer depend on one fragile source. This is where true financial freedom emerges, not just from saving, but from designing a system where money flows in from many directions. Part 9. The wealth of relationships and social capital. Money is not the only form of wealth. In fact, those who achieve true financial freedom often understand that relationships, networks, and social capital play an equally powerful role in creating opportunities and sustaining success. Wealth is not just about how much you earn, invest, or save. It is also about the quality of people around you, the connections you foster, and the reputation you build. The power of social capital. Social capital is the wealth stored in relationships, trust, goodwill, and collaboration. A person with high social capital has access to more opportunities, better information, and stronger support systems than someone who tries to go through life alone. When you have a network of people who respect you, value your contributions, and trust your character, doors open naturally. Job offers, investment opportunities, partnerships, and even protection during tough times often come through connections. In many cases, your net worth can be directly tied to the strength of your network. Building relationships with intention. To build meaningful relationships, you must approach them with intention rather than manipulation. Here are guiding principles. Ronos: give before you take. Offer value, encouragement, or resources without expecting immediate returns. This builds trust and reciprocity. Be consistent. Relationships thrive on reliability. Keep your word, show up when needed, and follow through on commitments. Listen deeply. Instead of seeking to impress others with your own story, show genuine curiosity in theirs. People are drawn to those who make them feel seen and heard. Invest time. Relationships grow with regular contact. Reach out, check in, and nurture connections even when you don't need anything. Align with values. Build relationships with people whose values align with yours. A network built on integrity is stronger than one built on convenience. The wealth of mentorship. Mentorship is one of the most powerful forms of social capital. A mentor provides not only knowledge but also perspective, accountability, and access to opportunities you might never encounter alone. Finding mentors requires humility. You must be willing to learn and accept guidance. At the same time, you should also mentor others. Teaching and guiding someone else reinforces your own understanding and strengthens your legacy. A culture of mentorship creates a cycle of growth where both parties benefit. The reputation economy. In today's world, reputation is currency. The way people perceive you can directly influence the opportunities you receive. Someone with a reputation for honesty, discipline, and reliability will always attract more partnerships than someone who is careless with their word. Your reputation is built on countless small actions. The way you treat people who can do nothing for you. The quality of your work even when no one is watching. The consistency between what you say and what you do. Guard your reputation carefully. It takes years to build but only moments to destroy. Leveraging networks for financial growth. Strong relationships and networks can accelerate your financial journey in several ways. Opportunities. Many of the best investments and business ventures are not advertised publicly. They are shared within trusted networks. Support in crisis. When challenges arise, a supportive network can provide financial assistance, advice, or resources that prevent you from falling behind. Collaboration. Partnerships allow you to share risks, pool resources, and expand faster than you could alone. Learning. Being in the company of financially literate and ambitious individuals sharpens your mindset and expands your thinking. Protecting yourself from toxic connections. Not all relationships contribute to wealth. Some drain energy, resources, and focus. Toxic relationships, whether personal or professional, can hold you back from financial freedom. Recognize these warning signs. People who constantly demand but never give. Individuals who discourage your ambitions or belittle your progress. Relationships built on jealousy, competition, or dishonesty. Protect your time and energy by setting boundaries. Surround yourself with people who elevate, not diminish your vision. Wealth is shared. Ultimately, relationships remind us that wealth is not meant to be hoarded but shared. A life of financial abundance without meaningful connections is empty. True prosperity is found when you can enjoy your resources with loved ones, contribute to your community, and uplift others through your success. The wealth of relationships creates a life of support, belonging, and fulfillment. While money may build comfort, relationships build legacy. Part 10. The Psychology of Money and Wealth Conditioning. Money is not just numbers in a bank account. It is deeply psychological. How you think, feel, and behave around money determines whether you will attract wealth or repel it. Many people fail to achieve financial freedom not because they lack opportunity, but because their mindset and conditioning around money are rooted in scarcity, fear, or misinformation. Understanding your money story. Each person carries a money story, a set of beliefs and habits shaped by upbringing, culture, and personal experience. Some people were raised to believe that money is evil, that wealth is only for the lucky, or that poverty is permanent. Others were taught discipline, saving, and the value of investing. Your current financial reality is often a reflection of your money story. To rewrite your future, you must first examine the narrative you have been living with. Do you view money as abundant or scarce? Do you see wealth as something achievable or reserved for others? Do you associate guilt, fear, or anxiety with financial success? Identifying these beliefs is the first step in reshaping them. Scarcity versus abundance mindset. A scarcity mindset believes there is never enough, that opportunities are limited, resources are scarce, and success is reserved for a select few. This mindset leads to fear-based decisions, hoarding, and reluctance to take risks. An abundance mindset, on the other hand, sees money and opportunities as renewable. It recognizes that wealth is created, not merely distributed. People with an abundance mindset are generous, optimistic, and willing to invest in themselves because they believe more will come. Shifting from scarcity to abundance changes everything. It transforms how you approach investments, relationships, and even setbacks. Emotional triggers around money. Money is emotional. It can evoke feelings of security, fear, pride, or shame. Uncontrolled emotions often lead to poor financial decisions, overspending when sad, avoiding investing out of fear, or chasing quick wealth to feel significant. The key is to develop emotional awareness and regulation. Before making a financial decision, ask, am I acting from fear, greed, or confidence? Avoid impulsive spending triggered by emotions. Pause, reflect, and act with intention. Recognize that self-worth is not tied to net worth. Money is a tool, not an identity. Reprogramming wealth beliefs. Wealth conditioning involves replacing limiting money beliefs with empowering ones. This can be done through education. Learn about money management, investing, and wealth creation. Knowledge dispels fear. Visualization. Imagine yourself living in financial freedom. Visualization helps your subconscious accept wealth as normal. Affirmations. Repetition of empowering money beliefs rewires your thinking over time. Environment. Surround yourself with financially successful people whose habits influence your own. The role of patience and long-term thinking. One of the greatest mental strengths in wealth building is patience. Impulsiveness seeks shortcuts, but shortcuts often lead to failure. Long-term thinking requires discipline to delay gratification and trust the process of consistent saving and investing. Wealth psychology is about understanding that prosperity is built over years, not weeks. Those who think long-term, planning decades ahead, inevitably surpass those who chase quick gains. Detaching emotions from wealth fluctuations. Markets rise and fall. Businesses thrive and sometimes collapse. What separates the financially free from the financially fragile is the ability to stay steady when circumstances fluctuate. Detachment means not panicking during market downturns or overspending during upswings. It means remaining consistent in habits regardless of external noise. Emotional stability is the shield that protects long-term wealth. Money as energy and a tool for growth. At its core, money is energy. It flows where there is value. It is not inherently good or bad. It takes on the intention of its user. In the hands of someone disciplined and purpose-driven, money becomes a force for growth, contribution, and freedom. Wealth psychology therefore requires respect for money, but not worship of it. You must recognize it as a servant, not a master. The moment you see money as a tool rather than a source of identity, you gain true control over it. Part 11. Building a lasting legacy. Financial freedom is not just about building wealth for yourself. It's about creating stability, opportunity, and impact that extends beyond your own life. True prosperity has three dimensions: personal security, generational wealth, and meaningful contribution. The responsibility of wealth. When you achieve financial freedom, you gain more than comfort. You gain responsibility. Wealth gives you the power to influence, to open doors, and to shape lives. The question then becomes, how will you use that power? Some will choose to create businesses that employ and empower others. Others will focus on passing down financial wisdom and resources to their children. Still others will channel wealth into philanthropy, supporting causes that uplift society. Whatever your choice, responsibility is the anchor that ensures your wealth matters. Generational wealth and education. Wealth that is not taught is wealth that is easily lost. Statistics show that within 3 generations, most families lose their fortune because financial education is not passed along. Building a legacy means going beyond money. It means transferring knowledge, discipline, and values. Teach your children or successors the importance of saving and investing, the difference between assets and liabilities, the mindset of abundance and contribution, the principle of stewardship, not entitlement. Legacy wealth is not measured in dollars alone, but in the financial intelligence instilled in those who follow you. Contribution as the highest form of wealth. Wealth without contribution often leads to emptiness. The most fulfilled individuals are not those who hoard money, but those who use it to make a difference. Contribution could mean supporting community projects, funding education, or mentoring the next generation of entrepreneurs. When money becomes a tool for impact, your wealth becomes more than personal. It becomes transformational, redefining success. Many people chase wealth for status symbols, cars, houses, or recognition. But lasting fulfillment is found not in possessions but in freedom. The freedom to spend time as you wish, to live by your values, and to shape your destiny without financial restraint. Success, then, is not just having wealth. Success is living aligned with purpose while using wealth to create a better future for yourself and others. Bringing it all together. Across this journey, we have explored the blueprint of financial freedom: mastering your mindset, managing your money with discipline, investing for growth, avoiding debt traps, building multiple streams of income, and shaping a wealth psychology that sustains you. Now the final step is application. Knowledge without action is wasted potential. Your financial freedom depends on daily choices, consistent habits, and long-term vision. Every step, whether it's saving a small amount, reading one more book on money, starting an investment, or teaching your children about financial discipline, brings you closer to a life of independence and impact. Final words. Financial freedom is not a distant dream. It is a blueprint that you can build, brick by brick, through consistent effort and intentional living. By mastering your mind, your money, and your habits, you take control of your destiny. Wealth is not only about what you accumulate, but also about what you create, share, and leave behind. Live wisely, build boldly, and let your financial freedom become a legacy that endures.